Clive, I want to lead with you and continue our conversation. I believe before break you wanted to respond to Mr. Stockman.
Yeah, what I want to say really is this. I want the old David Stockman back. I was in D.C. in the early 1980s covering Washington politics back then, and I was a huge David Stockman fan. When he was OMB, you know, he developed this reputation for speaking truth to power, talking straight, and he was in the policy mainstream making a difference. And I think that's where David Stockman should be. The problem with this book is that the prescriptions are so outlandish, so utopian, that he's put himself deliberately outside the mainstream of discussion about what we need to do to get the economy back on track. It's as though he's excusing himself from taking part in that serious discussion. Go back on the gold standard, dismantle the federal government. I mean, this is not going to happen, and he knows it's not going to happen.
No, but the point is the mainstream that I may or may not have been a part of in 1981 is so far off in the ditch that my whole analysis of the errors, in my view, of Nixon when he went to Camp David and crashed down Bretton Woods, fixed exchange rates, financial discipline, Reagan when we started on a path of fiscal solvency and responsibility and shrinking the government, went in the opposite way. Then Greenspan, who allegedly was a gold bug when they put him in, and he ended up being a serial bubble creator. And then Bernanke they put in, who basically said, if necessary, I'll drop money out of a helicopter, and he said that before he even went in. So I say the mainstream has drifted so far over the deep end that my whole analysis, the 700 pages, is out of the mainstream. And so the prescriptions, which are, a half a dozen pages, are in the same place. But the real debate in this country is, has all of this new permanent Keynesianism, and it's ironic with the death of Margaret Thatcher today announced, that we thought in 1981 at least Thatcher and Reagan had killed the Keynesian mythology that we could borrow our way to prosperity once and for all, that by having the government borrow money and passing it out to people so that they'll buy more flat screen TVs was a good thing. All that was dead. Here we are 30 years later, and we're back to the same old thing on steroids, and not only in the fiscal authorities, but in the central banks. All the central banks are pure Keynesian, propositions.
Then do you believe QE infinity is going to lead to just runaway inflation?
No, it's going to lead to an ultimate collapse in the bond market, because if you believe the bond vigilantes are dead, then you're delusional. The bond vigilantes are laughing all the way to the bank because they're putting on the ARB, buying the 10-year, let's say it's yielding whatever it is this morning, 1.7, and they're borrowing overnight money on the repo at 10 basis points, capturing the spread and sleeping like a baby because they know that Uncle Ben said the overnight rate is 0, will be to 215, and I'm going to be buying $85 billion a month in the long-term market and thereby keeping the price up. Now, this is dangerous because the minute the ARBs realize the Fed is going to stop or slow down or hint or even imply something, and they begin unwinding that trade, the selling crescendo, the selling avalanche will be monumental. They have no clue of how they're going to stop the selling once it starts.
Clive, is that part of or at least one of the parts of David's analysis that you do agree with?
I think there's something in it. I mean, I think he's exaggerating. He seems pathologically prone to exaggeration these days. But there's a germ of truth for sure in what he's saying. We all know that the exit strategy issue is a daunting one for the Fed. And with interest rates this low, you bet people are making mistakes, people are making investments they shouldn't be making, and unwinding all this is not going to be straightforward. But the question is, what is the alternative? I mean, Bernanke is right, in my view, to provide monetary stimulus to help the economy recover, to support demand. David would call that reckless Keynesianism. I think it's sensible macro policy. One of the things David says in his book is he's against macro management in principle. He doesn't want any countercyclical policy whatever. I find that very hard to take seriously.
Well, let me respond to that because I think 40, 50 years shows that macro management is the equivalent of a narcotic. It gives the economy a good high for a while initially, but it then becomes politically habit forming.
Is it the economy or the market?
No, it's both. The Congress cannot stop stimulating the economy because there's always some Keynesian economist will say it's a little too cool or it's slowing down or it's speeding up, but don't stop now. And the Fed
Well, they're stopping right now. They're stopping right now. The fiscal stimulus is being withdrawn, and in my view, it's being withdrawn too soon.
Well, I mean, if you believe that you can just borrow your way to prosperity, bury the next generation in debt, well, of course, that's what we're doing. And the thing about bubbles, nobody, we're in the world of the bubble blind. And I would say my opponent here this morning is one of the bubble blind. And, these are the arguments to have because, frankly, in 2007, I heard it, we're in the Goldilocks economy, everything's fine. Ben was trained by Greenspan, and so therefore we can count on Ben. They had no clue of the freight trains coming down the track. He didn't see subprime. He didn't see the housing collapse. They couldn't even tell that housing prices had gone up 200% from 95 to 208, and they couldn't see a housing bubble. Now, if you think people who believe all of this are giving you good advice now, or that this needs to continue, that's fine. I don't believe it.